Long time no see, this is Cleo. I came across a very interesting comment, which inspired me to make this video. So a while ago, I mentioned that Morgan Stanley had launched its Bitcoin ETF, and its 16,000 advisors were now actively recommending 2 to 4% of allocation. And the comment goes like, why are they pushing this now? According to the 4-year cycle, Bitcoin should be approaching its lowest point around October. Why buy it today when you can potentially pick it up at 30 or 50K later? Well, let me first clarify on what exactly is a 4-year cycle. It is a Bitcoin protocol. It is designed so that the block reward for miners is halved approximately every 4 years. This mechanism, known as the halving, reduces the rate at which new Bitcoin enters circulation. In theory, this creates a supply shock because on one hand you have fewer coins, on the other hand you have a growing demand for Bitcoin. So historically, it contributed to a significant price appreciation. In 2012, the reward dropped from 50 to 25 per block, and then 2016 it fell from 25 to 12.5, and following the most recent halving, which happened in 2024, it went from 6.25 to 3.125 per block. Today, with more than 94% of all Bitcoin that will ever exist has already been mined, and the remaining supply is limited, and the amount of new Bitcoin entering the market is relatively small. So as a result, the direct supply impact of halvings on the price has diminished. Therefore, I think it's reasonable to say that the 4-year cycle is no longer primarily driven by the halving mechanics themselves. What began as a fundamental supply dynamic has evolved into something more psychological and self-reinforcing. However, for investors, particularly retail, especially those people who have participated in early cycles, this pattern is kind of internalized, where they expect a bull run followed by profit taking and a sharp correction. So once they see this as a pattern, they kind of act upon it, and thus creating a self-fulfilling prophecy. This mindset was still evident toward the end of 2025 when some people sold in anticipation of the bear market, and that caused price to tank. And that triggered miners and proxies to sell, not because they wanted to, but because they had to. So this 40 to 50% drawdown, it does feel like a classic bear market. However, as macro conditions begin to favor Bitcoin, we do see institutions and businesses aggressively stepping in and accumulate at low prices. So basically, there's a transfer between retail and institutions. This also shows that the major institutions aren't strictly sticking to the 4-year cycle, they focus more on macroeconomic factors. So as JP Morgan has noted, Bitcoin's performance is being increasingly sensitive to macro conditions rather than halving events. We have Bitwise CIO Matt Haugen. He stated explicitly 4-year cycle is dead. We have Grayscale. They suggested traditional cycle thesis may no longer hold, with potential for new highs in 2026 without the classic blow off top and crash. Fidelity and others pointed out that Bitcoin's market cap exceeds $2 trillion. Volatility is declining, drawdowns are becoming less severe, and structural buyers like ETFs, corporate treasuries now dwarf miner issuance. So this brings us back to the original comment, why aren't these major players waiting for the supposed bottom? You see, the truth is nobody really knows because the market is inherently uncertain, and no one can really predict that there is going to be a bottom in October, or Bitcoin is going to revisit 50 or 30K, because history can only get us so far. What I'm trying to say is that you cannot rely only on historical patterns. You have to take into account of other factors to understand the chances of what's happening and what might happen in the future. And currently we are seeing substantial inflows from Morgan Stanley's Bitcoin ETF, and Goldman Sachs is actually filing their own Bitcoin Premium Income ETF. Last week, we got Charles Schwab announcing their upcoming launch of spot crypto trading, and today they released a video explaining to their audiences, the traditional 40-60 portfolio is dead, and you need to have crypto in your portfolio. The reality is that waiting for the perfect bottom often means missing the opportunity entirely. You may end up buying it at a higher price later. But if you're lucky enough, right, you did nail the bottom, then you buy it at a very good discount. At the end of the day, the decision is of course yours. If a certain price feel too expensive, then it's perfectly reasonable to stay on the sidelines. But for those who are viewing Bitcoin as a hard asset and see it as a long-term investment, the difference of you buying it at 50K or 40 or 30K, it's probably relatively minor in the broader context of Bitcoin's potential trajectory.